Today we added a little bit more to Altria Mo for its 8% dividend. You can see here we only bought about $200 worth, 5 shares, but you shouldn't click out of the video. We put most of our money in the indexes, like we've said countless times before, Cornerstone and these other funds, but we still want to have some stock exposure through Altria because it has an 8% dividend, but it also fulfills a major need in the portfolio, which is consumer staples. So it's an important sector. If you want to have a completely diversified portfolio of the S&P, you need to have the 10 sectors, and consumer staples are one of the 10. So a lot of them have had big moves, and it's tough to own them when they don't have large enough dividends to get me interested. We need something around 10% here to get me interested because we use margin and we want to cover the interest on our margin, which is about 5%. So Altria, as you can see here, it's way off the highs of 55 set just a year ago. So we have about 10 points upside just by looking at a 1-year chart. But it's also pulled back here a little bit from about 50-ish to the mid 40s. It's an attractive little pullback on the chart. So not only does Altria fulfill a sector that we need in our portfolio for diversification, which is consumer staples, it also is cheap. It's considerably off its highs, 10 points off its highs set here in May. But it's also had a nice little mini pullback here from 47 to about 46. It's only $1 or $2, but look, it's right on support of that blue line, which is the 100-day moving average, which is pretty significant that it's around that level. And you'll find that the S&P looks similar because the S&P is the entire market, and how it goes, everything else goes. And as you can see, it's had a recent pullback as well, and it's near that 100-day moving average too. So this is all common and expected and orderly. Altria is pulling back with the overall market. The question is Altria in good enough shape to sustain its dividend and its business initiatives, which it recently got into a new vaping line because it got rid of Juul, and now it's in it just bought a new company, which I'm not really concerned about. You can go look at that yourself. What I want to make sure of is that the dividend has been steady, and as you can see here, the dividend history over the last 5 years, the dividend's been steadily rising over the last 5 years. So even if they cut their dividends some, it would still be a rather high dividend. They have an A+, as you can see here as well, an A+. Over the last 53 years, they have an A+ rating of consecutive years of dividend growth. So this stock pays 8%. People like it on Seeking Alpha, and there are some people who don't like the new acquisition. But as long as the company's not going bankrupt, or as long as they keep selling cigarettes, which is, I hate to say it, a terrible thing, but as long as they keep doing that and hopefully transition towards these vaping materials, which, hopefully people will choose instead of cigarettes, even though those aren't healthy either. Hopefully that works out for them, but I think they'll still be selling cigarettes. In America, there's a lot less smoking, but when you travel around the world, people still smoke cigarettes heavily, especially in Europe and Asia. And cigarettes have high margins. If you look at what tobacco companies make, they have some of the highest margins in the industry of all the sectors in the stock market. So that's why they're able to have these high dividends. So that's why we want to add to Altria. It fulfills a sector-specific need for us for diversification. It's consumer staples, and we needed that in our portfolio because we don't have any other exposure to it. Nothing else pays a good enough dividend for it. So it fulfills that need. It's pulled back on the chart, as you saw, as we just showed. It's pulled back with the market, and it's well off its 2022 highs. Its dividend has shown increasing payouts to investors. So these are encouraging signs. So we only added a little bit because we always keep 1,000 in the stocks because our margin is pretty high. So 1,000 in these stocks: Citigroup, Devon. We've made past videos about, Citigroup's a financial, Devon's an energy, Altria is consumer staples. So we like to be completely diversified. Gut is utilities, and we have shorts here, obviously, too, a little bit of shorts, but we've sold puts in other areas to get the other bit of diversification. We've sold puts in consumer cyclical, which is one. And, the list goes on. UDOW for industrials, the top 10 sectors we've sold the puts on, so that, including owning a small amount of these stocks, so that we can get, it's like having a mini portfolio within the portfolio, so that you get added performance to the bottom line of your portfolio, which, as you can see for us, after today's action, we're up 20% for the year, and the S&P is up about 4%, and the NASDAQ's up about 9%. So we're beating the market with this strategy, and we're earning $100,000 a year in dividends. So when we added to Mo today, it didn't add too much to the dividends, but it pays our interest on the margin, and it never hurts to slowly increase your income wherever you can. So hope you liked the video. Subscribe and click like if you did. Comment if you think there are better consumer staples plays out there that have higher dividends. And I'll talk to you soon. Thanks.